Okay, welcome to our second Ask Matt a Question. Today I got a very detailed, long question in 4 parts with several subparts. So I apologize in advance. I am going to use my notes rather than try and do this all from memory. So at times it may look like I'm reading because I am. So without going into the whole preamble of the question, I'm just going to kind of summarize it. And it goes like this. The top 1% of Americans own 38% of all wealth. The bottom 50% own 2.5%. Historically, such inequality does not close peacefully. They either close through deliberate policy redistribution, higher taxes, structural reforms, or they close through conflict, which leads us to the questions. Number one, how do you see the resolution of this inequality? So before I get into the answer to that question, I want everybody to understand that while, yes, there is inequality as far as assets, which was what was stated, there's also inequality as far as taxes. In 2022, the top 1% of earners paid 40.4% of all federal income taxes. So to state that again, the 1% owns 38% of all wealth, but they also pay over 40% of all taxes. This group earned 22% of the income. So they weren't at 40% of all income, they were at 22% of all income and still paid 40% of the tax. So it's not as straightforward as oftentimes it's explained in news articles, newspapers, magazines. Yes, the top 1% do own a lot. They also pay a lot in taxes. The bottom 50% of earners pay 3% of total federal income taxes. Every month since this new administration has been in office, however, wage growth has increased in excess above inflation. So while you've seen the income gap maybe expand over time, we're actually seeing that finally the middle class is actually earning and growing their income versus their parents. They're starting to see more income over time. And that's again versus inflation. So it's real dollars, not just inflation is up 3% and their income is up 3%. And of course, one of the months, October 2025, there was no inflation number to compare it to due to a government shutdown. Other than October, every month in this new administration, you have seen positive growth in earnings against inflation. Tax relief and deductions. The bill aims to provide $1,300, and this is speaking of the big beautiful bill, $1,300 average tax cut for families making under $100,000. The initial numbers are coming up in higher than that. So we're seeing people save more than $1,300 in taxes. And that includes some of the major tax cuts, being an extra $6,000 senior deduction for those over 65, with a adjusted growth income of $75,000. And it expands the state and local tax, or the SALT tax deduction, from $10,000 to $40,000. And for those of you who live here in California and own a home, that should increase the amount of savings you have this year. So going back to the question, how do you see the resolution of this inequality? I feel like this administration sees the problem and is working on closing that gap. Many of the tax cuts, although they're portrayed as tax cuts for the rich, they're actually having a very positive effect on the middle class as you start to see that income coming in. Question number 2. Should the U.S. seek diversification from dollar-dominated assets? I believe he was asking denominated, but either way, we'll go ahead and answer the question. Yes, and they have. Digital assets could allow the US to drop the petrodollar power play and utilize bridge assets such as Bitcoin, recently used for exchange of oil with Iran. Also, XRP would be an excellent solution to that bridge asset question. This would allow countries to purchase oil and natural gas with their own currency, not have to exchange into dollars, and it would quickly be exchanged through the bridge currency to dollars for US companies or vice versa. This is one of the reasons the current administration has been pushing the Crypto Clarity Act. In many ways, this could create the rules of the road for this process. Also, they are building a crypto strategic reserve. Furthermore, much of what is backing the crypto market is what are known as stablecoins. These are coins that are tied to specific currencies, the majority being dollars, and they are backed by US treasuries. Those treasuries pay an interest rate, thus strengthening the backing of the stablecoin. And these coins often take the interest that they receive from the treasuries and purchase gold, again, adding more strength to these stable coins. Now, the stablecoin issuers hold approximately 155 to 182 billion in US treasuries. That's as of mid-2025. So that number could be much larger today. And it's largely driven by top issuers, Tether and Circle, backing their reserve with short-term T-bills. This amount surpasses the treasury holdings of many sovereign nations, such as South Korea and Saudi Arabia. The number one holder of US treasuries is Japan, with 1.1 trillion. And the stablecoin market is expected to reach 2 trillion by 2028. So surpassing the total, almost doubling the total that Japan currently holds, and nearly matching the total that Japan, UK, and China currently hold, thus reducing the need to rely on some of these other countries to hold our debt. Okay, number 3. The market is overpriced. Is a crash inevitable? Is government overspending postponing the crash? So again, multiple parts. The market is overvalued. And this is something we've talked about many times, and that's versus the historical norms. However, we have significant change in how the economy works coming in the next few years, including AI and how that will make the cost of workers go down significantly. The biggest cost to companies is paying employees. If you have an employee, you don't need to pay. You just buy that technology once. You've now reduced your overall costs. The second is tokenization. So it's expected that over the next couple years, all assets will be beginning, if not completely, tokenized. What that means is currently you buy a stock, it's a line item at a brokerage, but there isn't a actual, someone holds it for you. Tokenization would allow every single asset class, a share of stock, a home, a piece of art, to be purchased, and you become the owner, and it's authenticated by the blockchain. So there's an extra level of security there. And then from there, you can create fractional shares. So for example, 100 people could buy one share of stock, which would allow, number one, more people to enter the market. You don't need as much money to be able to do it. You'd have more specific ownership of said stock. And if, for example, you own a home, you could, instead of getting a reverse mortgage or something like that, you could actually sell a portion of your home and someone would own it, maybe a family member. So there's ways to utilize tokenization through those fractional shares to expand the overall economy. And then finally, markets opened to completely new investors, not just investors here in the United States, but all around the world. I don't believe, so the question is a crash inevitable? I don't believe a crash is inevitable, but I do think it's likely. which is why we currently keep an allocation around 25% in the stock market and invest in other non or negatively correlated assets. You can actually jump on YouTube and check out our February 2026 Matt Chat, where I go into much greater detail about how we do that, what that looks like. And then finally, on question 3, is government overspending postponing the crash? In some ways, government spending is always postponing or increasing the economy, but that's no different than normal. You have government employees that receive income that directly affect the economy, as well as government contracts that may support certain companies and their stock prices and their earnings. And then from time to time, you may have the government send out supplemental checks or do tax cuts. And those are all ways to keep money in the economy and keep the economy growing, which brings us to the biggest question in my mind of all. And again, this is something we've talked about many times. The debt to GDP ratio of the US is 123. The current administration wants to spend 1.1 trillion on the military while reducing Medicare benefits and other social services. How will this impact the market? Okay, so the debt to GDP ratio is and has been concerning. However, there are 2 ways to reduce the ratio. Number 1, you can reduce the spending and therefore the debt, cutting fraud and waste. So we're seeing a lot of that lately, fraud being identified specifically in California and Minnesota, cutting red tape and bloat. So we've had several government employees let go, found superfluous to government process. And then we've had a lot of regulations cut back and expenses cut back to move businesses forward, move building forward, to do a lot of things that increase the economy. And the final and most obvious is just spend less than you make. So forcing Congress to work within a budget rather than always wanting more. The number 2 way to enhance that ratio is to increase GDP. And one is to become more efficient. AI and crypto are tools that are absolutely going to be used and are being used to increase that efficiency. So the net output from those businesses, the government will increase, thus increasing the GDP. Number 2, build and create products and needs. So we're having a lot of companies move their manufacturing back to the US and investing in the US. For a number of reasons, that will increase GDP, it will add jobs, and it will create products and services that don't currently exist and at prices that are lower than they are currently. So creating possibly more demand. Again, creating an increase in GDP. And then 3rd, invest in infrastructure that allows for innovation. So this kind of touches on the AI and crypto again. It's been a very strong push of the current administration to make the US the AI and crypto capital of the world. Those 2 things are going to allow our GDP to accelerate very quickly versus our debt, eventually overtaking our debt. It's a plan in motion, and we'll see if it works. And then finally, ultimately, the future looks very bright as far as the economy and asset appreciation. There will likely be some bumps along the way, but the overall trend for incomes versus expenses and debt versus the GDP are moving in the right direction. I can't say this strongly enough. Everything looks like we're going to see a boom in this country over the next 5 years. The next year or so might be a little bumpy. We might see a drop in the market. We will likely see a drop in the market. So it's not a time to go in 100%. It's still a time to be cautious and invest in a way where you still get decent returns, but you're not taking on too much risk. When things become appropriately valued, that's when you can jump in and be a little bit more aggressive. I hope that answered the questions. Yeah, thanks.